Canadian, a 577 billion mortgage Ponzi scheme explained. Like, I know there's problems with housing, but that's
The first time buyer.
the $500 billion. Check this. Sure, everything's still going well with the stream. Are good. Great. Let's watch this one.
Buyer sits across from a loan officer in a bank branch in Mississauga on a Thursday afternoon. There's a stack of papers on the desk: purchase agreement, insurance disclosure, amortization schedule, rate hold, signature tabs in blue. The condo is small, the mortgage is enormous, the buyer signs. He believes the bank is lending him the money. He believes he has entered a 25-year financial relationship with the logo on the front of.
Like, there are some scary things with Canadian housing right now. The whole, from what I understand, when you get a house in Canada, you can't get a fixed mortgage rate. It's fixed, but it's fixed for 5 years. And then the mortgage rate has to essentially be redone. And so you'll get the new interest rate at whatever the market interest rate is at the time. So right now there's a huge problem of, during COVID, interest rates were forced way down, um, as a COVID measure to assist the economy. And now we're getting on to the time where it's 5 years later. All the people that had like super low rates are having to refinance at a much higher rate. It's causing a lot of friction because the monthly payment is skyrocketing in order to keep that. And then there's also a house devaluation that is currently happening where housing prices are coming down from their peak. So the house is worth less and you're paying more because of the higher interest rates. And I assume that's what this Ponzi scheme is going to be about.
The building.
What we're going to see.
That is a complete illusion. Within 90 days, that mortgage is stripped of his name. It is bundled with thousands of other insured loans from across the country. The bundle is stamped with a guarantee by a federal crown corporation. It is converted into a tradable security. It is sold to a pension fund in Alberta. The bank already has its money back. The bank is already using that same capital to fund the next buyer waiting in the lobby. The buyer in Mississauga has no idea his debt just became institutional collateral.
Looks like I'm completely wrong. They're talking about banks and what they do with your debt.
As of September 30th, 2025, the Canada Mortgage and Housing Corporation had $577 billion in total guarantees. In force, $175.3 billion of new mortgage securities were guaranteed in 9 months alone. The annual ceiling rises to $270 billion starting in 2026, $190 billion in new NHA mortgage-backed securities, and $80 billion in new Canada mortgage bonds. This is not a side pocket of the housing market. This is the funding spine underneath it. In the polite Ponzi scheme, we told you the housing market had become an extraction mechanism. This video tells you who is funding the extraction, how the machinery works, and why the Canadian taxpayer is unknowingly backstopping the largest real estate casino on the continent. You signed a mortgage. The system minted a bond. This is the mortgage bond trap. Start at the branch. The buyer signs an insured mortgage. That insurance is the passport. It is what allows the loan to enter the securitization system. Here is the paperwork journey. The bank assembles a pool of insured mortgages. Each mortgage meets specific criteria: loan-to-value ratios, credit scores, geographic distribution. The bank submits the pool to CMHC's Securitization Center. CMHC reviews. The pool is approved. The bank issues National Housing Act mortgage-backed securities backed by the pool. CMHC stamps the securities with a timely payment guarantee. Not eventual payment, timely payment. That single word changes everything. It transforms a private household liability into something institutional investors treat as sovereign quality collateral. Then comes the second layer, the Canada Housing Trust, a special purpose trust created by CMHC in 2001, purchases those NHA MBS from banks and issues Canada mortgage bonds to the broader market. The bonds pay semi-annual interest. At maturity, investors receive their full principal back. The proceeds flow to the banks as payment for the securities. The banks receive fresh capital. They originate more mortgages. The cycle repeats. The entire structure rests on two pieces of legislation that most Canadians have never read. Section 14 of the National Housing Act authorizes CMHC to guarantee payment of principal and interest on securities issued on the basis of housing loans. Section 4 states that every obligation incurred by CMHC is an obligation of Her Majesty. The guarantee carries the full faith and credit of Canada. It is a direct, unconditional obligation of the Government of Canada. The bank that originated the mortgage no longer owns it. The Canada Housing Trust holds it as collateral. The pension fund in Alberta holds the bond. The homeowner in Mississauga makes monthly payments to a servicing company that has changed 3 times without their knowledge. The money flows through custodial accounts, swap agreements, and reinvestment vehicles before reaching its destination. The buyer believes they have a mortgage with their bank. They do not. They have a mortgage with a machine. The loan lives in your name. The leverage lives in their system. Tell me in the comments, when you signed your mortgage, did your bank explain that your loan was going to be packaged and sold to a pension fund within 90 days? Now widen the lens.
So they do this to all the houses that are mortgaged? So the bank essentially doesn't hold the debt. It's like bought and sold.
Through the first 9 months of 2025, CMHC guaranteed $129 billion of new NHA mortgage-backed securities and $46 billion in new Canada mortgage bonds. Combined, $175.3 billion in new guaranteed mortgage paper in 9 months. Total guarantees in force reached $577 billion. Insurance in force stood at $462 billion. CMHC said it insured 20% of all Canadian residential mortgages. The ceiling is rising. Starting in 2026, CMHC can issue up to $190 billion in new NHA MBS guarantees annually and up to $80 billion in new CMB guarantees annually. That is a combined annual channel of $270 billion. Lay those numbers against the national ledger. The federal government spends approximately $93 billion on healthcare transfers to the provinces. It spends approximately $26 billion on national defense. The government authorizes more new guaranteed mortgage debt in a single year than it spends on the military, healthcare, and federal infrastructure combined.
Whoa. Let me hear that part again.
Of $270 billion. Lay those
So
numbers.
that's the amount that they're giving to like this mortgage back securities section. Essentially the debt that they're allowing to be taken out for homes.
Against the national ledger. The federal government spends approximately $93 billion on healthcare transfers to the provinces. It spends approximately $26 billion on national defense. The government authorizes more new guaranteed mortgage debt in a single year than it spends on the military, healthcare, and federal infrastructure combined.
Whoa.
The government is also buying its own product. It purchased $29 billion of fixed-rate Canada mortgage bonds in 2024. It purchased $29 billion again in 2025. The annual cap is $30 billion. The government is now the single largest purchaser of its own guaranteed securities. The balance sheet beneath that machine is not infinite. CMHC reported $357.5 billion in assets. $340
CMHC. What? Can you give me a breakdown of how CMHC works in Canada? CMHC. Let's see what it says.
$41.8 billion in liabilities and $15.8 billion in equity. Mortgage insurance capital was $12.3 billion. Securitization capital available was $2.6 billion. That is the reserve layer sitting under a system with $577 billion in guarantees above it. The scale reveals the priority. The Canadian economy does not produce innovation at this volume. It produces secured real estate debt. The numbers on the ledger do not measure prosperity. They measure leverage. Canada does not just tolerate mortgage leverage, it industrializes it. When you sever the relationship between risk and reward, you alter the physics of a market.
Yeah, because the bank's not keeping the debt at all.
In a traditional banking system, a bank lends $1 million and waits for repayment. The vault has limits. The bank is careful about who it lends to because it holds the ultimate risk of default. That discipline kept markets honest for centuries. The securitization machine destroys that discipline completely. A bank originates an insured mortgage. It pools the loan, it securitizes the pool, it sells the security, it gets fresh capital and fresh balance sheet room. Then it originates again. The vault never empties. The liquidity is perpetual. The bank earns origination fees.
Like that just seems like a dangerous system to have. The Canada Mortgage and Housing Corporation. It's a federal crown corporation. Okay. You know what that is? So it's partially run by the government of Canada. Well, many people think of it simply as mortgage insurance. It is actually the Swiss Army knife of the Canadian housing market, acting as an insurer, a lender, and a massive research hub. As of early 2026, here's the breakdown on how it functions. The safety net, mortgage loan insurance. This is the part most Canadians interact with. If you want to buy a home but don't have a 20% down payment, the law requires you to get mortgage insurance. How it works. CMHC insures the lender, the bank, not you. If you lose your job and stop paying your mortgage, CMHC pays the bank back. This lowers the risk for banks, which allows them to give you a mortgage with as little as 5% down. So it's offsetting the risk in order to allow banks to lend to a person with a lower down payment. The cost. You pay a premium, usually between 0.6 and 4.5% of your mortgage amount. Most people don't pay this up front. It's added to your total mortgage and paid off over time. So for this service, you pay a premium. I mean, like 0.6 ain't much, but like 4.5% of a mortgage in Canada, that can be a lot of money. So they lower the risk for a bank, charge you more in order to do that. 2026 rules. Maximum price. You can only get CMHC insurance on homes priced under 1.5 million. This limit was recently increased to reflect higher market prices. Amortization. Standard is 25 years. First-time buyers or those buying newly built homes can now opt for 30 years amortization to lower monthly payments. That's the payback period, right? 25 or 30 years. Credit score. At least one borrower typically needs a score of 600 or higher. The builder, funding and supply. CMHC is currently the primary engine for the government's push to solve the housing crisis. They don't swing hammers themselves, but they provide the cheap money to people who do. Apartment construction loan programs. Okay, Housing Accelerator Fund. MLI Select. This is a popular 2026 program for builders. If a new apartment building meets high standards for affordability, energy efficiency, and accessibility, the MHC gives a developer massive incentives, like 50-year amortizations and very low down payments. Okay, so this is like the government aspect of it, where it's pushing to essentially get more housing built and getting specific types of housing built, the type of housing that we need. Okay. The brain, research and data. If you see a headline about housing starts or rental vacancy rates, the data almost certainly came from CMHC. Market analysts, they track every single housing start in Canada. They use this to warn the government about overheating markets or supply shortages. Okay, so provide direct support, social and indigenous housing, manage the funding for non-market houses. This is the goal. Isn't profit. Okay. Summary table, CMHC's two faces. The goal for home buyers is to help you buy with a small down payment. The goal for developers is to get more rental units built. The main tool for home buyers, mortgage default insurance. The main tool for developers, low interest loans and grants. Who pays? For home buyers, the home buyer pays the premium. For developers, the federal government taxpayers subsidize. The benefit for home buyers, lower interest rates from the bank. The benefit for developers, higher density and faster approvals. Pro tip for 2026, if you're looking to buy your first home, check out the CMHC's Eco Plus program. If your home is certified as energy efficient, you get a 25% partial refund on your insurance premium. Okay, so this is a crown corporation that is definitely interfering with the market in a massive way. Let's see. What is it called? Oh, I'm way too high here. Canadian Mortgage and Housing Corporation. Is the Canadian Mortgage and Housing Corporation making homes more expensive in Canada? Let that think. Let's get back to it.
Servicing fees, and interest spreads. It holds none of the long term risk. The risk has been transferred to CMHC, and CMHC has transferred it to the Government of Canada, and the government has transferred it to the taxpayer.
So this is the risk of these loans.
It is perpetual. The bank earns origination fees, servicing fees, and interest spreads. It holds none of the long term risk. The risk has been transferred to CMHC, and CMHC has transferred it to the Government of Canada, and the government has transferred it to the taxpayer. This is why Canadian housing never behaves like a simple commodity market. The loan is not only a loan, it is raw material. Once insured mortgage flow becomes securitizable supply, the incentive shifts. The bank is not only pricing risk to maturity, the bank is feeding a pipeline that can be sold onward into a state-backed secondary market. The feedback loop extends into the bloodstream of the financial system itself. The Bank of Canada.
So this is done in order to allow people to get a home with a lower down payment, lower interest payment. But it's shifting the risk essentially from the bank to the government and therefore the taxpayer. So you're helping people get into homes and shifting the risk of that helping more risky people get homes and shifting the risk of that, which a bank would normally do, onto the taxpayer. I mean, that seems dangerous.
accepts NHA.
It seems like it would make housing prices go up if you do this. Let me see what it says. This is one of the most debated topics in Canadian economics. There isn't a simple yes or no answer because the CMHC pulls the housing market in two opposite directions at the same time. As of 2026, the consensus among economists is that the CMHC lowers the barrier to entry for individuals buying, but contributes to higher overall prices across the market. So it makes housing more expensive, but allows more people to get housing. Like, just lower housing costs, and you can allow more people to get housing. Like, if a 20% down payment wasn't so, a 20% down payment of such a large sum wasn't, like, if you lower the whole sum, you lower what a 20% down payment is, and then increase how many people can afford it and get housing. It seems like a really roundabout way trying to fix a problem without addressing the problem. Let's see what else it has to say. Like, in the previous video, we learned a lot of the housing prices is from like interprovincial barriers, and a lot of the housing prices also comes from like taxation. These are things that could just be fixed with a changing of the rules. The lowering housing prices is currently so politically charged that none of the political groups actually want to try and do it. Like, I remember hearing that the housing secretary of the current prime minister was saying that they are not aiming to lower housing prices at all. I mean, like, they're so inflated right now that it's going to happen whether you want it to or not. Let's see if I can find this. Let's go Toronto. Look at the average housing price in Toronto. Because I was watching a thing the other day too that was stating housing prices in Alberta and then places out west are actually like they're maintaining value because they were not as overinflated. But the areas that have inflated housing prices, like, let's see if we can find a chart. Not going to be a chart. Housing markets chart. Let's see if this is it. Okay. They're not the things I was looking for. Here we go. I love me a good chart. Can I zoom out a little bit to get this whole chart in? Toronto price history. We got the year 2021, 23, 24, 25, 26. And you can see that they are all on a downward trend. We have detached homes, free townhomes, condo townhomes, and condos. All of them are on their way down. That's going to cause problems, and they're probably going to keep going down. Like that chart. All right, here we go.
MBS and dedicated.
I was reading something, wasn't I? Yeah. The yes argument, how CMHC pushes prices up. Critics argue that the CMHC acts as a massive subsidy for housing demand, which naturally inflates prices, increasing buying power by allowing people to buy with only a 5% down. The CMHC puts more buyers into the market, more buyers competing for a limited number. Like, of course, you allow people to buy a house with a 5% down, going to increase the number of buyers, increase competition, therefore that would increase the demand and increase the price. Risk removal for banks, since the CMHC and therefore the taxpayer guarantees the loan, the banks are much more willing to lend large sums of money. Yeah. The price ceiling effect. Historically, the CMHC insurance limit, previously 1 million, now 1.5, 2026, acts as a target. Sellers often price their homes just below these thresholds to ensure buyers can get insured financially, effectively anchoring prices at a higher level. Oh, that's crazy. Like, I feel the housing market would function better without this aspect of CMHC, or perhaps without CMHC in its entirety. Gemini, check the source of Gemini. I mean, like, you gotta figure this is pulling, like, best way I can check is to ask something else, to ask a different AI tool, but I don't got time to go through all the links of where it's pulling this information. Let's have a look at what this says. Housing Corporation. Critics argue inflate housing demand and thus prices. So it's giving me the same information. Decades, demand side focus, oversupply constraints. Effectively adds buyers faster than supply can respond. Arguments that CMHC does not make homes more expensive or tries to mitigate it. CMHC and supporters counter that its program stabilize the system rather than inflate it. Risk management and stability. Insurance protects the financial system from defaults. Yeah, but it moves the pressure of the default. Important in a turndown, and insured lenders often offer reasonable rates to a wider pool of borrowers. Without it, many Canadians couldn't qualify for mortgages. Well, the other way to fix that is to lower home prices. They want to keep home prices high. See, yeah, because with important things should be if take from the same source. I think you are looking at important stuff. I understand. Um, I think AI's come a long way. Like, for fact checking and looking these up, like, it gives me sources. Is the other one giving me sources too? It is. direct links. atriusgroup.com, building solutions, the impact of CMHC loan, Canadian rental development, key highlights. Okay, I do gotta keep that in mind and look at those as well to see where it's getting its information. All right, supply side efforts. CMHC funds or ensures multi-unit rental program incentives for affordability, accessibility, and sustainability. It provides research. Okay. Affordable challenges are broader. These own reports attribute high price mainly to chronic underbuilding related to population growth, especially post-pandemic immigration surges, high construction land costs. Not as insurance programs, affordability has worsened. Yeah, it was just only to say, like for example, sometimes shows me information found to Facebook, for example. I get information to Facebook isn't the best solution. Isn't the best. I understand that for sure. Mm. The best I can do is keep an eye on these, and I will be switching between like the different AIs I use because we're in the AI bubble. So AI is free right now. So I might as well use them all and find the best one. Eventually they're going to make us pay for it, but right now we can get it for free. So let's see here. Overall assessment. This is what I want to read. CMHC's programs do facilitate more borrowing and buyer participation, which can exert upward pressure on prices in a supply-constrained market, especially when combined with rapid population growth and limited new construction. This is a common critique of government-backed mortgage insurance in many countries. It boosts access in the short run, but can capitalize into higher prices if supply doesn't keep pace, which it hasn't. However, blaming CMHC alone oversimplifies things. Canada's housing crisis stems more from regulatory barriers to building, zoning approvals, development charges, demographic pressures, and construction costs than from mortgage insurance. Okay. So they're saying that the CMHC is not a significant factor in the rise of home prices or essentially the housing bubble we currently see. Good strategy. Gotcha, it's a good strategy too, but what are Italy so I'm looking at the Canadian system of housing. I was actually watching a video that I'll eventually get back to and get to the bottom of. But I was just checking a lot of the information they were providing. So let's see. The CMHC itself acknowledges persistent affordability issues and focuses heavily on the need for vastly more supply. Recent policy changes under its umbrella, higher price caps for insured mortgages, appear designed to help buyers in expensive cities, but carry the risk of further demand side stimulus. Whether this makes homes more expensive depends on the time frame. Short term, yes, for some segments. Long term, it depends on whether supply responds. In summary, CMHC contributes to demand side dynamics that can elevate prices, but it is not the root cause, nor is it primarily trying to make homes expensive. Its mandate leads towards access and stability, with mixed success amid deeper structural problems in Canadian housing. True relief likely requires faster approvals, zoning reforms, construction productivity gains far beyond what mortgage insurance alone can deliver. Okay. You're doing a stream. All right. Thanks for checking in. Twitch. I'm gonna have to have that show on the stream over here somewhere. I'll figure that out. Um, so then this is something that most countries have. I was reading somewhere in here. Go back to this one for now. Major buyers. If you are an individual buyer, the CMHC makes your specific home more expensive to buy, but it's often the only reason you can afford to enter the market at all. You're looking at the national economy. The CMHC is widely seen as a majority factor in why Canadian home prices are among the highest in the G7, as it has spent decades fueling demand while only recently focusing on the supply side. Oh, so it's saying that, who's the other one here? The side for renters was first, and only recently had it gone into like assisting the builders in starts. Okay. Um, do many of the G7 nations have a similar program to the CMHC? Let's see, because our housing prices are out of control. Let's go back.
Repo
Watch
operations.
more.
It accepts housing-linked paper inside its collateral framework. Canadian banks use NHA MBS as high-quality liquid assets under Basel regulations. They pledge these government-backed securities as collateral to borrow short-term cash. A housing debt has become the foundation of the entire banking system's liquidity. This is the trap. The system cannot stop originating mortgages without collapsing bank liquidity. The government cannot stop guaranteeing without triggering a credit crunch. And the homeowner cannot stop paying without losing their home and destroying their credit. Everyone is trapped, but only the homeowner bears the full consequence of failure. Bank of Canada research confirms the temperature. One paper found that higher loan-to-value ratios amplify housing market boom-bust cycles. Another found that the stress test dampened mortgage credit and house price booms. A third found that credit leaks toward less regulated channels when one part of the system tightens. Read those three findings together and the message is blunt. Cheap, scalable, government-supported mortgage funding does not just support housing, it changes the physics of the entire market. The machine does not care if you can afford your home. The machine cares that you keep paying. Quick poll for the comments. What keeps Canadian housing inflated more? Low supply or guaranteed credit that never dries up? Canada avoided a housing crash in 2008. The United States did not. Canadians have been told this proves our system is superior. It does not. It proves our system was bailed out faster. When the global financial crisis hit, Canadian banks faced the same liquidity freeze as American banks. They could not sell mortgages. They could not fund new originations. The system was seizing. The government launched the Insured Mortgage Purchase Program. Over the next 2 years, CMHC purchased $69 billion of insured mortgage pools from Canadian banks. The program limit was $125 billion. The banks only used $69 billion, but that was enough. The purchases provided immediate liquidity. The banks kept lending. The housing market kept rising. But the Insured Mortgage Purchase Program was not the whole story. The Canadian Centre for Policy Alternatives revealed that total government support for Canadian banks during the crisis reached $114 billion at its peak. This included CMHC purchases, Bank of Canada emergency loans, and access to United States Federal Reserve facilities. 3 major Canadian banks were effectively underwater. Without government support, they would have failed. And here's the detail that no one discusses. While American homeowners were defaulting and the U.S. housing market was imploding, Canadian banks were among the largest foreign holders of American mortgage-backed securities. They profited from the American collapse while being protected from their own. Look south for the mirror. The Federal Housing Finance Agency said Fannie Mae and Freddie Mac had $5.3 trillion of guaranteed mortgage-backed securities and debt outstanding when they were placed into conservatorship. The stated reason was brutal. Capital had eroded, market confidence had vanished, and Treasury support was required. Canada's system is not identical, but the family resemblance is obvious. A state-supported mortgage securitization machine can look stable for decades, right up until the housing cycle turns and the public balance sheet is forced to prove the guarantee in real time. The American system encouraged risky lending through subprime, no documentation loans. The Canadian system requires insurance, full recourse, and documented income. Those are real differences. They mattered in 2008. But the structural similarity is more important than the regulatory differences. Both systems transform mortgage debt into securities. Both rely on government guarantees to make those securities attractive. Both create moral hazard by separating the originator of the loan from the bearer of the risk. Canada did not escape the mortgage machine. It nationalized the shock absorber. Remove the acronyms. Look at the people trapped at the bottom of the ledger. When this machine works, the profit is concentrated. The bank originates. The securitization channel funds. The investor collects sovereign-backed cash flow. The housing market stays elevated. The homeowner is told their asset is wealth. When the machine breaks, the losses spread outward. The CMHC holds $15.8 billion in equity against $577 billion in guarantees. If a sustained wave of defaults burns through that capital buffer, the full faith and credit obligation activates. The federal government pays. That means every taxpayer, including the ones who will never own a home. The renter who cannot afford to buy is paying taxes to backstop the mortgage of the investor who outbid them. The young couple living in a basement apartment is providing the sovereign guarantee that allows a bank to issue a $2 million mortgage to a speculator. The worker who was just laid off, one of the 84,000 we documented in the payroll collapse, is still paying into the system that protects the balance sheet of the institution that holds none of the housing risk. The stress environment is not theoretical. CMHC insured mortgage arrears hit 0.32% in the third quarter of 2025, rising from the year before. Toronto's arrears rate has more than quadrupled from post-pandemic
Arrears rate.
before. Toronto's arrears rate has
Okay, let's see what this says. Yes, most G7 nations have a program that mirrors the CMHC, but Canada is actually quite unique in how concentrated and dominant its system is. Is that why our house price is so high? It was saying that that's more. I mean, it is a factor of it. The government plays a supporting role, whereas in Canada, the CMHC is the star of the show. Here's how the G7 counterparts compares. The United States FHA, the Freddies. The US system is the most similar to Canada's, but is split into different agencies. The FHA, this is the direct equivalent to the CMHC insurance. It allows Americans to buy home with as little as 3.5% down. Fannie Mae and Freddie Mac. These are government-sponsored enterprises. While they don't deal with you directly, they buy mortgages from banks to keep money flowing in the market, similar to the CMHC's securitization rule. Okay, so the other nations are doing this as well. They take a mortgage and turn it into a security that is then supported by the government. Gosh, this money stuff gets complicated. Like all major economies have something similar. So what were the things leading to housing going up? What did they say? Demand side, but it's not the root cause, nor is it primarily trying to make homes expensive. Its mandate leans towards access and stability with mixed success amid deeper structural problems in Canadian housing. True relief likely requires faster approvals, zoning reform, and construction productivity gains far beyond what mortgage insurance alone can deliver. These are the true factors keeping housing prices high. Let's watch the end of this.
More than quadrupled from post-pandemic lows and is projected to keep climbing through 2026. Ontario's delinquency rate rose above the national average for the first time since 2012. Meanwhile, 1 million plus mortgages are entering the renewal cycle in 2026, with average payment increases of 20%. The feedback loop is now working in reverse. Job losses reduce demand. Reduced demand lowers prices. Lower prices eliminate equity. Eliminated equity removes the buffer against default. Default triggers the guarantee. The guarantee draws on reserves. Exhausted reserves draw on the taxpayer. If the homeowner breaks, they lose their home. If the institution breaks, the government steps in. The individual is allowed to fail. The institution is not. The public is already underwriting the private risk. They just do not get the upside. Close the folder. A first-time buyer in the GTA signs a mortgage and thinks they borrowed from a bank. Within 90 days, the debt has been pooled, guaranteed, securitized, and sold. The bank has its money back. The buyer has no idea. And $577 billion of guarantees in force hum quietly behind the transaction. The buyer thinks in payments. The bank thinks in pools. CMHC thinks in guarantees. The Canada Housing Trust thinks in bond issuance. Institutional investors think in sovereign-backed yield. The Bank of Canada thinks in eligible collateral and market functioning. The taxpayer thinks about none of this until the bill arrives. That is the full machine, and that is what this video adds to the Hush canon. The polite Ponzi scheme told you the housing market became an extraction model. The blueprint trap showed you the deposit machine. The variable rate mortgage trap showed you the payment shock. The payroll collapse showed you what happens when the labor market weakens at the same time the debt load stays high. The Two Canadas trap showed you that the map has already split. This video gives you the hidden engine under all of them. Canada's housing market does not just happen to be expensive. It is structurally funded to stay expensive. The guarantee machine ensures mortgage credit stays liquid, prices never fully correct, and the deepest tail risk migrates onto the public balance sheet. The profit is private when the market rises. The guarantee is public when the market trembles. The system is not broken. It is operating exactly as designed. The lease is up. Canada did not build a housing market. It built a mortgage funding state. Drop a like so more Canadians trapped in the housing machine see the plumbing underneath it.
So then the question is the CMHC like, is it too aggressive in what it's doing? Because clearly you need something like this because every major economy has some way of taking mortgages and turning them into like a security that's backed by the government. They don't lend the money themselves, they support private banks by ensuring the loan, setting the standards for how houses should be built. So like the system itself, it's hard. It definitely will have an upward pressure on home prices. And the more aggressive the system is, the stronger that pressure will be. But without it, you got a lot of people that can't afford homes. I mean, the ideal role would be if you fixed a lot of the underlying factors were outlined here, faster approvals, so reducing regulations, zoning reform. That's something that you could do at a local level, right? Who does zoning again? It's not federal. Yeah, I'm pretty sure that's the municipal that controls zoning. So this is a municipal issue. And construction productivity gains, that's something that we're struggling with everywhere, right? The whole houses are built outside, not in a factory, makes it that a lot of our productivity gains that we've been getting in other areas don't translate over to the construction of houses. That's a complicated one. But as I showed earlier, like the housing market is correcting, at least in certain places in Canada. Let's go through some of the comments. Oh, this is really new video. 5 hours. Okay, what are people saying? When you get a mortgage for a wild priced home, you're not getting a loan you'll ever pay off. You're agreeing to a perpetual payment, rent. If you default, you'll be eternally hounded and the government will take ownership of your home slash condo. It's just subtle communism because in the end you won't own anything, but you'll be obligated to work. Think all of those Branton mortgages that were secured, fake income statements. When the music stops in 2026, it's going to hurt real bad. Where was that? Get it? Like, the issue we have is that people that got a house here at the peak, which was right near the end of the pandemic or during the pandemic, the house they purchased is a lot lower value. And when it's hard to meet a payment at this high level, suddenly having a house that you're getting refinanced, and so now you know it's worth a lot less. That's just like sitting at here. So, 300,000 that you're losing on the average price of a detached home over the course of the last 5 years. Like, that's brutal.